Abhishek Bansal, CFO at JustDial, as well joins in to talk about their earnings. Abhishek, hi, morning. Steady revenue growth sequentially, but the operating performance seems aided by good addition of paid listings, which I guess onset lower realizations for you.
See, for the last quarter as well as for last full year, as we have mentioned in the past, we have very closely tried to monitor our three key parameters. Firstly, the traffic growth. So last particular quarter, we had about 139 million quarterly unique users, which grew at a steady state of 25% year on year. Mobile traffic, which contributes broadly about 80%. On mobile itself, we today have about 110 million plus unique users. That is growing at 40% year on year. In terms of monetization, last full year we ended at about 14% growth. 4Q ended at about 16% growth. So overall trends have been pretty healthy. Most importantly, in terms of free cash flows, last full year we generated about 349 crores of total free cash flow, which was about 30% plus growth year on year. Despite returning 220 crores back to shareholders as part of our buyback, we were still able to add 130 crore to our cash reserves.
Okay, so what kind of momentum do you see in the paid listing additions, the near term, and is competition high from here, from names like a Google, or is weak economic growth, soft sentiment among SMEs and elections going to keep your Q1 numbers in check?
See, paid listings, for the first time we have crossed 500,000 paid campaigns. So paid campaigns had about 12.5% year on year growth. Last 3 quarters, if you see, we have been adding close to 12 to 15,000 paid campaigns net on a quarterly basis. We have added 1,200 people in feet on street cold calling team over last 1 year. As and when these folks become productive, that helps in adding to paid campaigns, and naturally that flows into our revenues as well. So we do expect that particular trajectory to continue. And as far as macro sentiment is concerned, despite whatever macro challenges that are there, we have still been able to grow our revenues at a pretty healthy rate over the last 1 year, which also shows the strength of platform, which shows that how important JustDial as a platform is for SMEs.
All right, higher contribution of paid listings from tier 2 and tier 3 cities also seems to be something that we've picked up on this time. Abhishek, just talk us through the trend there.
See, when we look at revenue, we mostly first of all look at the overall revenue. Obviously, overall revenue has 2 levers, paid campaigns as well as realizations, but we don't worry much about whether the growth is coming out of paid campaigns or it is coming out of realizations. It's the overall revenue that has to grow first. I try to maximize my revenue per sales employee, revenue per customer. So 12.5% year on year paid campaign growth with 3% growth in realizations, I think is pretty healthy. Realizations, as you said, that because the mix is shifting towards tier 2, tier 3, where the ticket size is lower, they do have a downward pressure. But every year we do roll out certain new product offerings so that we can couple them with our existing core offering for SMEs, which helps us maintain or even grow our realizations. So despite venturing more into tier 2, tier 3, I think we have been able to fairly do a decent job in terms of maintaining realizations, and the same should be sustainable going forward as well.
Your EBITDA margins improved as well, despite an ongoing addition of feet on street as well as JD ambassadors. What efforts are you taking to improve productivity, and how much scope on tighter control on operating costs would you have to lift margins further?
Last full year we delivered about 26% EBITDA margin versus 21% previous year. So a 5 percentage point margin improvement I think is substantial. A lot of it was driven due to operating leverage. On the cost side, efforts are on to have costs as much in control as possible, and the rest let revenue growth take care of margin expansion. So I think similar trends should continue going forward as well. As a business model itself, this business has very high gross margins, 60% plus. So that itself lends a decent amount of operating leverage at 10% plus revenue growth levels.
Abhishek, what's going to be the ad spend run rate in FY20 versus what we've seen in FY19? And can you update us on any upcoming product releases?
FY19 full year we spent broadly about 57-58 crores on advertising. The thought process on advertising is that we want to we are comfortable spending 7 to 8% of our top line towards advertising. There could be bit of quarterly fluctuations, but the current run rate of 17 to 18 crores a quarter, I think that should definitely continue. At the same time, we want to ensure that our traffic growth remains closer to 25% overall growth levels.
And leave us with what you're aiming for FY20 in terms of your EBITDA as well as your overall revenue growth.
EBITDA margin, as I mentioned, that there is definitely a scope of expansion if we are able to continue or better our revenue growth rates. On the monetization side, as I said, that 139 million unique users, if we continue to grow our traffic, if we continue to roll out features which makes users engage more with the platform, it will eventually result in more SMEs signing up with JustDial, same SME paying more to JustDial. So last year we ended the year overall at about 14% revenue growth rate. Hopefully we should be able to better these particular growth rates going forward.
Okay, and what about your cash equivalents to the tune of about 1300 plus crore rupees? Any utilization plan that you may have for the year ahead?
Last year we generated overall broadly about 350 crores of total free cash flow. Out of that, 130 crores got accreted to balance sheet, and the rest 220 crores was distributed back to shareholders. In a year we can do buyback only once, so at the right time board might take a call to return a part of the cash that we have on our books as part of buyback. At this point of time we don't think there are any relevant inorganic opportunities, so we want to make sure that the cash that we have on our books, we maintain decent whatever rates on that, keeping principal protection in mind. So that's a thought at this point of time.
Okay, great to have you on the show and talk about your numbers. Thanks very much.